Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. In this weekend's edition, we're going to be focusing on the resource sector, talking more some individual companies, some investment strategies around investing in resource equities, as well as more big picture views on what's driving some of the moves in the precious metals, as well as some of the base metals, maybe some other metals that we'll get to as well. We're kicking off the show with Joe Mazumdar, editor of Exploration Insights. Now, Joe, you've been joining us on a monthly basis to share your thoughts on what's going on within the resource sector. And what I want to start off with today is the investment landscape, or at least your investment narrative, when we look at exploration companies that have investments or some sort of partnership with major mining companies. Now, I'll first break it down into two different factors here. Major companies can invest in the equity of the underlying exploration company, so they get exposure to all of the projects, or they can choose specific projects and have individual earn-in options on one or a basket of these projects, all with different stages of earning in. Let's start here, Joe. How, when you're an investor, do you look at these two different type of relationships between majors and exploration companies?
All right. Thanks for the question, Corey. I could probably give it to you from two perspectives, actually, or three. I can give it to you from the retail investor, so what I would look at it as an investor in that junior. I can also tell you what it's like for the junior, because I spend a lot of time with these CEOs, but I also could tell you from the perspective of the major, because I used to do that as well when I worked in corporate development for Newmont. So if we start with the major, if they like a project, they usually like to do a footprint into the company, up to a 19.9% stake. And this is, not unlike marking your territory for, apex predator. And that way telling the other ones that this one's mine. To do it at the project level means less liability for the company, because then they're just earning into the project and they don't have to do a lot of due diligence on the company. Like, does the company have other liabilities? Does the company's management team have any pending lawsuits or anything like that? What you would want with respect to a clean structure is just take equity in the project and not buy shares of the company. So that way you don't have to buy the company, you get the project, and eventually potentially dilute the company out and leave them with an NSR. That would be a clean way of taking the project out, because you're probably not interested in taking out the entire company. From a small company perspective, depending on the company, like with Hercules Silver, when they hit that intersection at their project in Idaho that I visited last year, their management team did not want a project earn-in. They would rather the equity, because I think from their perspective, the equity can come and go, but it doesn't. There's less risk of another player coming in and bidding them up. Whereas if the major gets an interest in the project, it's harder to find somebody else to come in. And from the perspective of the investor, it's always nice to see a major come in to put a bit of a stamp of approval on the project and or the management team. With respect to exploration, like we were talking about, the multi-year program earn-ins that companies like Headwater and Inflection are doing. What is nice about those is that you can think about the long term, because exploration, grassroots especially, exploration is about the long term. 3 to 5 year funded program that doesn't need a lot of money, but it needs consistent funding. That way you're not always trying to drill the next intersection because you have to go back to the market in March. This way you'll have funding. And at the beginning of the year, you're always looking at, okay, what's this next year's program going to look like? And then say, this would be what I'd like to do, but might be what I can only do because the market is a lot worse this year. Whereas for somebody like, let's say, Inflection or Headwater, they're more guaranteed of their programs for the next year. And that's basically what grassroots explorers need. So I hope that handles all three perspectives.
Thanks for breaking that down, Joe. And just a follow up on that, as far as retail investors listening to this call or looking at companies that have that strategic partner coming in at an equity level or a project level, yes, it does give them the vetting and it is good to see. But some people have made the point that you really want to see companies that have maybe a couple of these in there at 10% or less. So maybe a 10%, a 7%, a 5%, as opposed to just the 19.9%, because it limits the amount of suitors that could actually take over the project down the road. What is your thought on that debate of having multiples in at smaller levels versus one larger one at 19 or even at 50%?
Yeah, no, I think if you could do that, there's very few companies that are able to do that. I mean, Aurion have that. They have, a few majors with equity positions in them. I mean, Origin has Altius that has an equity position in them. They don't have another a major royalty company with an equity position in them. But yeah, I would guess, like, if you want the potential for a multiple bid, you would want multiple players that have interest. I mean, you wouldn't necessarily need two or three with less than 10%. But even if you have one less than 10%, it's sort of saying to the other one that they could come in and they could still acquire the company and bid the other one out. But somebody with 19.9%, it's harder to do.
So, Joe, what are these majors looking for when they do enter these sort of partnerships, especially on a project-specific aspect? Because, as you said, they can have multiple drill programs here. So it's not so dependent on, let's say, the first drill results. But let's say, if you're an investor in these exploration companies, what do you need to see in terms of exploration progress to have confidence that that major isn't going to exit that relationship?
Yeah, you can have something that's more project specific, that, okay, here's the project and we're earning into it and we're going to be drilling it and it's got to meet this criteria. So with B2Gold going into Snowline, it's definitely the Valley prospect that they're looking at. Drilling that, infilling that, looking at, infrastructure, looking at all that sort of stuff. Very specific to that project. Whereas AngloGold Ashanti with Inflection, that's more grassroots exploration. So what they're doing and spending money on, Inflection, is basically stuff that they're not doing. So they don't have an exploration team that's doing what Inflection is doing. Inflection came up with the idea. They have the people that understand what they're doing. And basically AngloGold Ashanti is supporting them with even more geophysical data than Inflection would have thought that they would get access to. More geophysical interpretation than they would normally have been able to do. And so the goal of AngloGold Ashanti basically is to find another Cadia, which is obviously a tier one copper gold asset, that, one of the assets that Newmont bought Newcrest for. But that same host rock called the Macquarie Arc that trends to the north in New South Wales goes under soft cover. And that's where Inflection is. They know the Macquarie Arc keeps going. They've drilled it. Now they have to look for the same types of deposits under cover. That requires a multi-year commitment. And AngloGold Ashanti is very willing to do that because the prize is very significant. If we look at Headwater, the initial agreement was signed by Newcrest, and their idea was to look for not Carlin type, but low sulfidation epithermal types of deposits that were underground, 1.5 to 2 million ounces of high grade. But what's happened since is Newmont has taken over Newcrest, and they have a bigger hurdle with respect to how big the deposit's got to be now, because now it's a much bigger company. But also, AngloGold Ashanti in the background has found the Silicon Merlin deposit, which is about 14 million ounces in all categories in Nevada. in the Walker Lane belt. So now that's a different model looking at the same ground where Headwater already is. So to be able to find something like that is what would interest Newmont, and potentially same sort of deposit style, but now you're getting into that deposit style could be something that might be tier one for a Newmont.
Well, Joe, just in thinking about this, as far as strategic companies coming in, the larger companies, and partnering with the smaller exploration companies, there's a point where you brought up earlier Aurion Resources having multiple partners. If we look at the Finland area right now, it's actually pretty exciting with a bunch of companies jostling for position. You've got Agnico Eagle that has an operating mine there that has positioned in Rupert. They also just took a big stake out in FireFox, which, to your point earlier, is kind of like saying, hey, this is the area we're interested in. You've got Kinross inside of Aurion, but you also have the JV partnership they had with B2 Gold, and now that JV partnership, the 70% that belong to B2 Gold, Rupert wants to buy it, but Aurion has this right of first refusal to bring in somebody else. When you see a bunch of majors in an area, kind of an area play, does that give you more confidence as an investor that, hey, this is something that obviously multiple big boys are interested in?
Absolutely. So Finland infrastructurally is excellent. For the types of deposits they can discover, develop, and put into production are much more profitable despite the latitude because of the infrastructure advantages. Kittilä, which is Agnico's mine, would not be built if it was in Canada. It's 4, maybe 5 gram underground, refractory. There's no way you would build that project in Canada. You would be dealing with diesel power and infrastructure issues, ice roads, and all that other stuff, camps. Whereas these people drive to work every day. They have grid power, which is mostly hydro, that comes right to site. And, it's open all year round. There's no, port facility that's required to bring in all the equipment. So Finland is excellent with respect to infrastructure. But then you add a high-grade open pit deposit, which is what Ikkari is. So you've got a potential major deposit here in a great jurisdiction, all the infrastructure you could want, but the problem is the land position requires a layback that would make that mine much more profitable than the scoping study suggests. The pre-feasibility study that Rupert was planning on doing in the first quarter has been pushed back. Why? Because I don't think anybody who wants to take over Rupert wants to see a feasibility study where they can't lay back further to the south onto the B2 Gold Aurion joint venture. So they're asking whoever they are, the suitors, which I would think would be Agnico and potentially B2 Gold, because even if they sell their part of the joint venture, if Rupert or somebody can consolidate that area, they will definitely be a takeout target. The game is definitely afoot in that area of Finland, and for me, that's an exciting. Probably, it's about I think it was 60 days from the initial announcement that something's going to give, and so that's an exciting one to watch.
So, Joe, with so many companies active here and consolidation needed, but some clear suitors that could do that consolidating, as an investor, how would you invest in this area if you wanted to put some money at work?
Well, I already have. I'm in Aurion Resources. They're the cog in that entire agreement to consolidate. And if it was a weaker player or in weaker hands, that right of first refusal, I might have sold it earlier. But because the chairman is David Lotan, and I just spoke to him in Zurich when I was at the Swiss Mining Institute. I've got all the confidence in the world that he'll do the best thing for shareholders there, as he is himself one of the bigger shareholders of the company.
So, Joe, one more company that I want to get your quick insights on that has a strategic investment that actually has just made a new discovery that really got moving this week in the market was Aurion Resources in Côte d'Ivoire. I've had them on the show a number of times earlier. We've seen a management change. We've seen almost a renewed effort in terms of exploration and a new discovery that the market took note of, that Charger discovery. What's your takeaway from this, at least initial discovery?
Well, I mean, kudos to the management team, the exploration team. They've done an excellent job. I owned that one a while ago, back in 21, and this was a really, decent 6 cent private placement. I think it hit $1 yesterday, but I sold it probably because of, well, for sure because of all the reasons you just mentioned. There were management issues and my focus at that time was more on the Empire prospect, which was just to the south, and that hit some 100 gram-meter intersections as well. But the continuity wasn't there, and they weren't able to reproduce it. And since they've gone through a few other prospects, and I think that the Newmont joint venture, although it looks now very inexpensive, $15 million to get 65% of that land package. It looks cheap, but at that time where they were getting no fundamental support from the markets, it looked good. 12 cents, equity private placements, the joint venture. So they knew that they had money to continue, and they were able to drill these sort of holes. Because if you look at the cross section, there's 2 holes that they drilled. There were scissors, looked like scissors on the cross section, and they didn't hit much. But they drilled a hole underneath that was at a different orientation, according to Andrew Chubb, who's now the CEO and formerly the VPX, because they thought, this other orientation of structure might have been better. And with that, they hit this whopping hole. In this intrusion that's brecciated, where they get the breccia and they get the really good silicification is where they start getting these 200 plus gram per ton intersections over a meter. So yeah, very impressive. Looks cylindrical and it's very structurally controlled. So kudos to Andrew. That was a very good bit of exploration.
Well, and Joe, this brings up one of the areas of the resource space that gets exciting for investors, and that's the potential of M&A and the potential of takeovers and the good old-fashioned bidding wars. And we did just see a bidding war with Osino, where Dundee Precious Metals came in to make an offer, and then a Chinese consortium ended up buying the project out. It was actually a win for shareholders. Instead of a take under, we actually had a legit takeover. And then we're seeing a move by Alamos Gold to move on Argonaut. So this brings in the larger discussion of M&A in the sector. I'd love to get your thoughts on how you see things shaping up.
Oh, absolutely. I think M&A in the gold sector is, obviously a good sign that companies want to make their acquisitions happen before they think the valuations are going to get higher. So M&A is always a good sign that the market's about to turn. And with respect to Osino in Namibia, a multiple bid, increasing offers and converting to all cash. So I think Dundee, which had a large working capital position, was going to offer 50% cash, which was also a nice offer and also at a decent premium. But then Yintai came over them. The only risk there is the Canadian government. And if they sort of put the kibosh in it because it's a Chinese acquirer, let's see what happens there. But otherwise, yeah, that's definitely a good sign with respect to the gold sector.
What else are you watching for in terms of M&A? Because even with this M&A, we always hear some of the naysayers saying it was a take under. I'm with you, Joe. I think all M&A is good. It frees up capital. Unfortunately, it can lock in losses for some investors, but that's just what happens sometimes in this sector. What else are you looking for on the M&A front that could cause some excitement or at least free up some capital for investors?
Okay, I mean, if we just go back to what I just said about, where the market is and, multiple bids, higher premiums. So just last year, probably a lot of people were complaining about the B2 Gold, acquisition of Sabina, and they called that a take under. But it freed up capital and got people away out of Sabina because they knew the big capital was coming and, then they would have to come to the markets to raise it. So we've definitely had a change. If we go a little bit deeper into the Alamos Argonaut thing, Argonaut bought Prodigy Gold for the Magino deposit. I visited that project, and their deeper drilling did show signs that they had the same high-grade mineralization that was what Richmont had. Richmont is what Alamos bought. I think that acquisition is predominantly about looking for extensions to the Island mine, because that's where Alamos has been making more of their money. So that one makes a lot of sense to acquire. As we see a lot of M&A now that makes a lot of sense, prudent, and the investors are getting paid, I think that's a very good sign for the entire gold sector. Going forward, besides Aurion that we just talked about, the other one that I would look forward to for a potential M&A is Aurion Royalties, which for their 1% NSR on that large, 10 to 14 million ounce silicon deposit that Anglo Gold Ashanti is advancing in Nevada.
Well, Joe, it's interesting you bring that one up. We actually just had Aurion on the show not too long ago. We were talking about just how significant that cornerstone asset is. But in the royalty space, compared to most of the precious metal sector, we actually did see a couple of years ago a lot of M&A activity. We saw LA Gold taken out and Abitibi Royalties and Golden Valley. We saw a hostile bid almost on Elemental, but then they merged with Altus. You had Mavericks and Nomad scooped up by Triple Flag and Sandstorm, respectively. When that happens in the royalty space, when a junior royalty company is acquired by a larger company, do you like that as an investor? Because it usually goes into a more solid company, but it's a slower moving company with less torque.
From the perspective of an investor, if somebody is offering you cash, I think your only risk is if they are raising the cash from debt. Otherwise, if they have the working capital and it's all cash, you probably care less about the company that's acquiring. If you own, if it's like 50% shares or 100% shares, like a lot of these royalty deals are, you do care about the acquirer. You care about potentially the leverage within the acquirer of the asset that you may still like. So if we take Aurion, that 1% on a potential tier one asset, if you want to keep holding on to that new company, because, we've seen this before where tier one assets don't get acquired once, they get acquired multiple times. And like Fosterville, Crocodile Gold, Newmarket, Kirkland, Agnico, same asset, being bought for a higher and higher valuation as it progresses. So that potentially could happen. And for that kind of exposure, and if you want to hold on to it, you would be more concerned about the acquirer.
Joe, what about the acquisitions or potential acquisitions of what we have seen, these development stories where it seems like companies might be running out of money or at least having trouble getting it past the finish line, and another company does need to step in? Usually they have cash flow of some sort, but they also need to raise money on the back of it. I know it's individual case by case basis, but what have you seen when we have seen these type of acquisitions happen and the time frame afterwards?
Well, I think right now the most undervalued sector, or stage, let's say, of the gold sector, and also probably in all the sectors, is the development stories, because of the paucity of retail, and probably more problematic, the paucity of institutional equity. There's not a lot of support for development stories. So there's unique stories like G Mining Ventures, which is building the Tocantinzinho gold project in Brazil, that have a lot of support. But they've got the Lundin Group, they've got I believe Pierre Lassonde, they've got a whole bunch of notables that are helping them with funding. But there's very few development stories out there that have that kind of multiple support networks, which is exactly what you need. So for a company that does not have a pipeline, that's looking for the next development project, this is an ideal situation to look at whatever development story is out there and acquire it probably at a discount, as long as you can bring hopefully a better way of developing it, some synergies with your own project, which is probably similar to what Alamos is doing with Argonaut. There's synergies there, potentially with the Island Mine and Magino, and potentially what's underground underneath Magino. So as long as you could bring that to the party, this is a perfect environment for those people that want to step into that stage.
Well, Joe, just to that point, for people looking at the developers in the gold and silver space or even in the copper space, whenever there's a big M&A deal, people get very excited. But the truth is, most of the projects sit on the rack year after year, cycle after cycle. There's some projects in the gold space that have been there for 2 or 3 cycles already and have never gotten bought out. How do you separate the projects you actually think are going to get taken over from the ones that are not going to build the mine, but they're just sitting there waiting with their hat out, hoping that they get taken over?
Due diligence. You got to go look at the asset, look at how good it is or bad it is, and see if it's going to work. And so those are the ones that in the letter we don't buy because there's no ultimate game there. Problematically, they could still go up in share price in the interim, but there may not be a suitor at the end of the day. And that's the kind of stuff we do here at Exploration Insights. So we try to look for that fatal flaw early. And but the problem is that, I don't buy knowing that there's a fatal flaw, thinking that somebody else will buy it and the share price will go up. I don't tend to do that. I just won't touch that one. And so, I mean, that's exactly what we try to do in the letter. And that takes work. That takes site visits. That takes reading through the technical reports and all that sort of stuff to know, which project will work and which won't.
Joe, give us a breakdown on the investment landscape that you see then for this sector, because broadly the stocks have rebounded. A lot of upside still to go in a lot of these equities, but it does seem like the majors are starting to lead the way a little bit. Even this week, we saw a bit more action in some of the ETFs. There's been a general uptick in some interest in the equities, but again, it's still lagging a lot of other sectors and still lagging the gold price. So what's your assessment of the overall investing landscape right now for the mid-tiers and the juniors?
Well, I think the gold price is there. There's no debate about where the gold price is and where it's going. The problem is the cost structure for the producers is increasing probably at a higher pace, compressing people's margins. And it's those people that can control their costs are the ones that are going to win in this current environment. And it's those people that have a comparative advantage, that they have infrastructure and they can acquire these assets at a fraction of the price, but also they can cut the capital costs because they're already in the area. Those are the sort of synergistic M&A that it's a perfect, the environment is ripe for that kind because the gold price is there, but the valuation isn't there for the potential M&A targets.
All right, Joe, we're going to wrap it up here. Thank you so much for sharing your thoughts on a wide variety of kind of investment angles for exploration equities and even some of the mid-tiers. I really do appreciate all of your insights through Exploration Insights. I recommend everybody checking out that newsletter if you already don't know about Joe and what he does in terms of the due diligence and market research into all of these companies. Joe, we'll chat again next month. I hope you have a great rest of your weekend.
Great. Thank you very much, Corey and Chad. We'll see you guys.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first 2 segments with Joe Mazumdar, focusing a bit more on the resource equities. In these final 2 segments, we're chatting with Jeff Christian, managing partner at the CPM Group. We're going to be talking gold and silver, more the broader markets. CPM Group just released their gold yearbook, which I recommend you all check out. A lot of information within that over 200-page report focused on the gold market. Jeff, let's start off with a consistent driver behind gold demand. That's been the demand out of the East. China, as well as a number of other countries, have continued to build their gold reserves. We talked about this actually a few months ago, where this is, I believe, a 10-year trend that we've seen some higher demand from the East. How do you see this playing out? What's some of the more up-to-date data that you have?
Well, yeah, it's interesting, and it's actually been going on since about 2008 or so, and it's varied from country to country. Our data now for the full year of 2023 was net central bank buying of about 14 million ounces, and of that, if you disaggregated it, about 18 billion ounces or 18 million ounces gross purchases, of which 7 million ounces were the People's Bank of China. So the People's Bank of China has been buying consistently now since November of 2022. They've been absorbing a lot of the gold that had built up in market inventories within China. And they've probably absorbed most of it now, so that you've got a Chinese market that is more tighter, more balanced. And I think that's being reflected in an increase in Shanghai premia over the London market. India, and China has been adding gold to its monetary reserves since 2009. India had earlier been a seller, but they started reversing around the same time, and they bought some gold, and then they walked away, and then they come back in buying. Basically what you've got is India and China, first off, proclivity toward gold. But if you look at Greater Asia, these are countries that have a proclivity toward gold as an investment and as a form of savings and a monetary reserve. And there are also countries that don't have a lot of gold reserves in their central bank holdings, partly because they weren't major trading partner countries during the Bretton Woods system. If you look at like Germany, which has close to 100 million ounces of gold in its reserves, all of that gold was built up between 1950 and 1971 by virtue of the fact that people were buying German goods and paying for them with dollars, and then the Bundesbank would take those dollars and buy gold from the U.S. Treasury at $35 an ounce. After the Bretton Woods system ended, they stopped buying gold, but all that gold was built up during the Bretton Woods dollar gold standard, when gold was used for international trade and capital flow settlements. India, China, a lot of Southeast Asia, East Asia were not major trading countries back then. They became major trading countries starting in the 80s and 90s, and they collected a lot of dollars. So whereas Germany, the United States, France, the UK, Italy had maybe 80 to 95% of their monetary reserves in gold, these countries had 80 to 95% of their reserves in dollars. And what you've seen since 2008 is a lot of central banks saying, we need to diversify away from dollars. It's not that we want to dump dollars, but we shouldn't have 80 to 95% of our reserves in dollars. So let us buy some gold, let us buy some euros, let us buy some other currencies. Some countries will try to match their currency foreign exchange reserves to their trade flows. So, depending on how much they're buying and importing from various countries, they'll try to have that percentage of their foreign exchange reserves in that country's currencies. So you've seen this diversification. It's been going on now for about 16 years, and it's likely to continue going on for decades to come. So it spells good. It's good for gold and gold price expectations because it's pretty much a consistent demand. Obviously, if you look at China, they were big buyers through June of 2019. when the price went over 13.50, they stopped buying because they didn't want to chase the price higher. When the price came down back to 16.40 in November of 2022, they started buying again. So you can expect some price sensitivity, you can expect some cyclicality, but over the long run, you should expect a lot of these central banks to be consistent long-term buyers of gold for addition to their monetary reserves.
Yeah, Jeff, it's been interesting to watch the Asian buyers be very savvy in buying when there's pullbacks in the price, but also to your point, many central banks just diversifying out of their currencies and putting a portion of it into gold along with other foreign currency exchange just to diversify their asset base. But on the retail investor side or the institutional investor side, I'd love to get your thoughts on what patterns you're seeing, because the pattern has been in the ETFs outflows. And you had made the point on our show a few times, that's because people were really shifting more to holding the physical metal. But even recently, we've seen some inflows into the ETF. So what's your outlook on the retail and institutional investors?
Yeah, it's interesting because I believe through January, you were still looking at pretty hefty outflows from ETFs. I'm just looking at January. At the end of February, you had 3 million ounces of net withdrawals or redemptions in gold ETFs, and that's reversed in March. It's a kind of an interesting phenomenon, because if you look at other markets like India is looking at record high gold prices and weak rupee, so they've pulled back in March from buying as much. Chinese demand may have softened a little bit. Some of the institutional investors that we know of in the United States and high net worth individuals pulled back. You've seen some softening in March in investment demand from various sectors, but others have poured into the ETFs this month. And I think what that reflects is investors who were not necessarily active gold investors, but saw the gold price rising, and it's like, how do I buy gold? Well, the ETF is the easiest thing to do. So I think that's what you're seeing with the inflows in March, is investors saying, I want to get on this gravy train. Gold is making record prices in March. Let me buy some ETFs. It'll be interesting to see if that continues, or if some of those guys then convert, liquidate their ETFs and buy physical metal to hold it on a different basis, which is really the trend that we saw over the last 3 years plus. Since 2021, we've seen investors selling their ETFs, about 6 million ounces of sales last year. Overall, investors were buying about 25 million ounces of gold last year, but ETF holders were actually reducing their gold holdings to about 6 million ounces. And, that was, to us, that reflected concerns over the financial market and financial industry stability. That you had investors saying, I do want to have exposure to gold, but I don't want to have counterparty risk that I have with ETFs, because these things are, at the end of the day, equities that are managed and administered by financial institutions. And that's been a trend over the last couple of years. It'll be interesting to see if that resumes if the price plateaus.
Hey, we've even seen an increase in some of the GDX and GDXJ volumes too, which does, at least to me, show a little bit more interest in the sector. What about the COT reports, the Commitment of Trader reports? What have you noticed within those reports that show renewed interest by certain investors? Give us a breakdown of what you've been seeing in those, please.
I haven't really been looking too closely at the COTs, but what we've seen is relatively steady demand in the futures and options markets. You've seen the gross short positions of institutional investors have declined from around 15 million ounces down to about 5 million ounces or 8 million ounces. So there's been a reduction of the number of institutions that were willing to play gold on the short side compared to where they were, say, a year ago. And then you've seen a little bit of a pickup, maybe 20% pickup in the gross long position too. So there's some repositioning on the part of institutional investors in the futures and options market where they're showing greater bullishness or greater expectations of really short-term gold price moves.
Jeff, when you look forward at forecasting, you're always very pragmatic and look at the supply demand picture and look at price trends, look at the annual average. Do you have any idea of where gold could be heading, let's say over the next 12 to 18 months? Because we hear a lot of wild projections out there that it's now breaking out, but I'd love to get your thoughts on forward looking, how you see the price moving in gold.
Yeah, we've been bullish on gold. We expect the gold price to set new record levels this year. We're a little, well, let me first say, we have been saying that we thought that the gold price would rise to record levels in 2024 and probably again in 2025. And on an annual average basis, the annual average price has been a new record for the last 4 years. So we think that's going to continue for the next 2 years. What surprised us is that we thought that the demand for gold would be a little weaker now in the first quarter than it has been. We've seen very strong demand for gold at times, and we've seen the gold price, push to new records, like I said, twice in the course of March to date. That tells us that investors are very much concerned about future economic developments and political developments. Our expectation is that the gold price may cool off a little bit in the second quarter. There's some seasonality there. And also, we are seeing some price hesitancy to buy at record prices. So, we might see prices plateau, but they're plateauing at a much higher level than we thought. And our expectation now is that the gold price will indeed set new records and that the gold price will be much stronger in the last 4 months of this year into 2025 than they are now. So we're looking for record prices. Now, when we say record prices, we're not talking about $30,000 gold or $10,000 gold. But, if you look at the gold price on an annual average basis, last year was a very strong record, and the average price was $1,953. This year, the price is probably going to be at least 10% higher than that on an annual average basis. Now, if that means that the gold price averages, say, something north of $2,050, so up $100 or more on an annual average basis, the intraday price will be that much higher. And I could easily see $2,400 or even $2,500 an ounce gold over the next 12 months on an intraday basis. But remember, those intraday spikes, they last for like 10 minutes or 20 minutes, and then the price comes down. So we're looking for higher prices. We think that the world is going to be more treacherous 12 months from now than it is today, or especially 9 months from today. And we think that investors, we're looking at the economy. They'll see a weaker economy by then. They may see more concerns about a recession in late 2024 or 2025. There's going to be a lot of political issues, not just in the United States, but around the world and internationally. And we think that the combination of all of those factors are going to cause investors to pick up their gold purchases. And if they bought like 24, 25 million ounces last year, they might buy 28 million ounces this year. So we're looking at strong gold market this year and next year, and it's based partly on the supply demand and investment demand trends, central bank demand, but it's also based on our economic and political outlook.
So, Jeff, how does this all carry down to the gold stocks then? I know you talked to a lot of the larger gold mining companies, and broadly, the larger gold mining companies seem to be more interested in combining with other larger gold miners and shedding non-core assets. Does this higher gold price environment change any of their strategies, and how do investors look at the gold stocks in your eyes?
Yeah, I'm not a gold stock analyst per se. We analyze the gold stocks because we need to know, we need to have a view, our own view as to what future production is going to be from these companies. I think that the higher gold prices will, attract more capital to these companies and will make them more desperate to find mergers and acquisitions because that's what they've tended to do in the past. And you may well see some greater dividends being laid off because some of these guys have pretty good profitability even on an all-in sustaining cost basis. The question in our mind is how much of the money will be spent on exploration and pre-development work as opposed to mergers and acquisitions. And our view is that the focus will be on mergers and acquisitions at the expense of exploration and pre-development, which is sad because that exploration and pre-development really needs capital to fund future production.
Well, we'll keep eyes peeled out for more M&A. It does get the animal spirits going in the gold stocks, though. Jeff, we should also probably talk about silver. A lot of interest still in what's happening with the silver price. It has been a little peppier lately. What is your outlook on silver?
Well, silver continues to lag gold, and I think that reflects some investor reluctance to get into silver. There's some investors who have been disappointed that the silver price didn't do what promoters had said it would do. Our expectation is that the silver price will do well. It's probably going to trade between, say, $22 on the low end and $28 on the high end for most of this year. I wouldn't be surprised to see the price testing $28 by the end of this year. Part of that's going to have to do with what happens politically within the United States and internationally in Ukraine and Europe and the Middle East.
So, Jeff, in terms of what's driving silver recently, everyone always wonders, is it the industrial demand? Is it the precious metals demand? What could provide that boost to get silver out of this kind of longer-term downtrend? Is it one or the other in your eyes?
It's got to be investment demand. I mean, fabrication demand provides a solid base for silver, but, I don't think that fabrication demand has a profile that's going to be such strong increase that it will drive the price higher. One of the things that we've seen last year and continuing in this year is really much weaker investment demand. And it's going to take a turn, a reversal of that trend in investment demand to drive the price higher. And one of the things is, the silver market is tight enough that if you saw like a 20 or 30 million ounce increase in net investment demand this year from what we're projecting, that probably is the difference between $22 and $28.
Well, Jeff, if the net investment demand is really what drives the silver price around the periphery, how much weight do you give the manufacturing side of the business? Because to Corey's point, we always hear it's a hybrid metal, and we always hear about its use in solar and in medical, and there's a lot of uses in electricity and in even some of the new EVs, but it doesn't seem like that's what really moves the price. It really seems, to your point, that it's really the investment demand on the edges that's moving it. How much weight do you give the industrial part of the silver story?
Oh, we pay a lot of attention to the industrial side and to gathering intelligence so that we can estimate how much silver is being used in each of those industries. And, solar has been the big growth story for the last 10 or 15 years, and it's probably going to continue to be the big growth story. But, it's not as big as the promoters let you have it. There is a price sensitivity across fabrication demand. So, if you look at the relationship between prices and fabrication demand, it's a negative correlation. Higher prices, fabricators will try to reduce their per unit silver use, and they can do that, and they can substitute other commodities or other metals for silver in some applications. Although, silver is the substitution for palladium and gold and various electronic applications. But, it's very important to understand that fabrication demand because that's taking silver out of the market. But the price is negatively correlated to fabrication demand. The strongest growth in fabrication demand tends to come when the silver price is low or falling, and if you look at then the correlation between investment demand and prices, that's positively correlated in that investors will chase the price higher. When the price falls, investors get disillusioned and they sell, which is one of the things that we saw last year. A lot of disillusioned investors selling their silver, in some cases buying gold instead, in some cases just walking away from the precious metals environment. And that's what kept the price lower. But the investment demand is positively correlated to price. As investors buy silver, they'll drive the price higher. As the price rises, other investors will say, oh, the price is rising, I got to be back in silver, and they'll buy it. So investors will chase the price higher, while fabricators will wait for lower prices to buy more silver. Fabricators aren't going to say, oh, the price of silver is down, so I'll use more metal, or the price of silver is high, so I'll use more metal. They're going to say the price of silver is high. This is a raw material in my product. What can I do to lower the raw material costs of making my product?
All right, Jeff, I want to ask you more big picture about the environment that we are in the financial front. We have gold at all-time highs, U.S. markets broadly at all-time highs, and even the dollar, yes, it's off its highs from a couple years ago, but right around that 104 level, we would have to go the whole way back to about 2002 when the dollar was hanging out more above just that 100 on the dollar index. So we can even say that the dollar is still broadly in historical nature strong too. What is this environment that the markets are living through right now?
I think one of the key things to pay attention to is investor concerns and central bank concerns about financial industry stability. It's very interesting because, you have a relatively good economic environment. You have inflation coming down. You have interest rates plateauing. They haven't been rising. They haven't been falling, but they haven't been rising. And you have relatively good economic activity and a strong stock market. And investors and financial market regulators are looking at the world and saying, okay, this is probably the best that we can expect. And the economy weakens from here. And we have certain inflationary risks that we have to watch out for. And we have recessionary risks that we have to watch out for. So this may be the best economic environment. And in that environment, you're seeing investors buy a tremendous amount of U.S. treasuries. They need U.S. dollars to do that. So the dollar's strong, the treasuries are strong, and gold is strong. Investors are buying a lot, 24, 25 million ounces of gold at record prices in a strong economic environment. That tells you that when the economic environment gets worse, they're probably going to buy even more gold, and the price of gold will go even higher. But the thing that gold promoters get wrong is they focus on the treasury, and they keep talking about the treasury market's going to drop and no one's buying treasuries. In fact, the amount of treasuries held by investors are at record levels, and the amount of treasuries held overseas by international investors are at record levels. You have more than $8 trillion in U.S. treasuries held in overseas accounts. And that's because the treasuries are relatively lower risk than other sovereign debt, corporate debt, stocks, and everything else. So what you're seeing in the treasury market and in the debt and stock market, a lot of investors saying, okay, I've got very good profits built into my stock position and my bond position, but I'm very nervous about what comes next. And I'm also very nervous about my risk to financial intermediaries as my counterparties. So treasuries, you get rid of that. And so you've got this shift in the treasuries. You're seeing a similar thing in gold. Like I said, over the last 3 years, you've had investors buying 25, 26 million ounces of gold each year, physical gold, but you saw net sales of gold ETFs. And that's because those ETFs have financial intermediary counterparty risk. So what you're seeing are investors around the world saying, I'm worried about the future, and I'm worried about counterparty risk in a more hostile future economic environment. And that's why you're seeing investors buy gold and U.S. dollars and U.S. treasuries right now. They're looking at their counterparty risk and they're saying, I have to reduce that as much as possible ahead of the next financial crisis.
All right, Jeff, we're wrapping it up here. Thank you very much for your time. Very interesting comments on how you see gold moving here. It's quite a bullish outlook, and it makes sense as long as it kind of plays out as you have said. This maybe looking further out to the end of this year, early next year, is some more economic issues rearing their head. Everyone, thanks for tuning in on this weekend show. Be sure to check out our website, kereport.com, and podcast The KE Report for all our daily editorials and company updates. Jeff, again, thank you for your time. Everyone, thanks for tuning in. I hope you all have a great rest of your weekend.